Hello everybody, hope you're having a good day today. Today we're going to finish off chapter 9. Today will be probably a fairly short lecture in finishing off chapter 9, so that will give you some time to complete the exercises for this particular chapter. And remember, I will be posting the solutions for those probably early next week. And then next class we'll be moving into chapter 10, basically switching over on the other side of the balance sheet. Today we'll finish our discussion on the asset side of the balance sheet, and then we'll switch over to the other side, the liabilities and the shareholder equity, and spend the next few classes talking about the components of the financial statement on that part of the balance sheet, and also then moving into a discussion about the income statement. So today we want to pick it up where we left off the other day. So I'm just going to pull up the PowerPoints and we'll go over to the point where we left off. Okay, back a bit. Okay, so you may recall the last class we finished off by talking about partial year depreciation. That's where we own an asset for only part of the year. And then we talked about capital cost allowance. You see in this particular PowerPoint, it uses the phrase tax depreciation. You don't hear that term very much anymore because most people that talk about depreciation know that under the Income Tax Act, depreciation is referred to as capital cost allowance. Sometimes people who have been around quite a while, even older than I am, will use the phrase tax depreciation, but it's very uncommon today, okay, just so you're aware of it. Normally people use the term, again, depreciation if you're talking about the normal financial statements, or capital cost allowance if you're talking about the tax records of a corporation. Okay, so we want to go forward from that point. The next topic in this chapter, when we're talking about depreciable assets such as buildings and equipment, it talks about changes in depreciation. So you might recall we mentioned the other day that depreciation is really a process of estimation. Right? We don't really know when we buy an asset how many years that asset is going to last, and we don't really know 100% certainty how much we'll be able to dispose of that asset for at the end of the asset's economic useful life. These are all estimates that we use in accounting. However, as we also mentioned, this brings up the importance of ethics in accounting. We want information to be reliable, so we want accountants to prepare information using a high order of ethics so that people are not misled by information that is knowingly false. Okay, so in this particular PowerPoint, it states the amount of depreciation depends on three items: the recorded cost of the asset, the estimated useful life, so how long is the asset going to last, and its estimated residual value. One point I'll mention here that we didn't talk about in last class, when we talk about the estimated useful life of an asset, that is the period of time that we own the asset that it will be economically useful. We may actually legally own the asset for a much longer period of time. So for example, we may build a manufacturing building and use that building for 40 years. But when we're done using the building, we may put it up for sale, but we might not be able to find a buyer right away. Right? So we might actually own the building maybe even another 10 years, another 20 years before we can sell it. So the legal life of an asset can be longer than the economic useful life of the asset. Okay. Again, my building example, we may use the building in our business operation for 40 years, but we may own the building for a much longer period of time. And then, of course, as is mentioned in the PowerPoint, what's the residual value at the end of the time when we stop using the building? So today, that building, for example, that we built, that building, let's say, cost $30 million. And we estimate today that in 40 years, we'll be able to sell that building for $3 million. But when we move forward in time and we actually arrive at year 40, maybe we can only sell that building for $1 million. Okay, so because our estimates in hindsight might prove to be inaccurate, we have to be able to record in the financial statements changes, right, that we make in these components. So normally, it's going to be either the economic useful life that will change or the residual value. So management is charged with the responsibility of reviewing these components each year to make sure that their depreciable assets are being properly depreciated, right, with proper residual values and proper remaining useful lives. So in this particular example, we're going to talk about what happens when we change the useful life of the asset. So in the given information, it says that the original depreciation expense, we're going to do a calculation here, $60 million will be the original cost of the asset. $3 million will be the residual value. So the depreciable cost is $57 million. And then that particular asset is going to last 20 years. So the straight line method, we take 1 over 20, multiply that by 57 million, and we get the depreciation expense will be $2,850,000 per year. Now let's say we use that asset for 4 years. Right? So the total accumulated depreciation at the end of the 4 years would be $2,850,000 times 4, or $11,400,000. So at the end of year 4, well, our book value, right, of this piece of equipment is the original cost, 60 million, minus the accumulated depreciation of 11.4 million for a book value, or sometimes I mentioned it's called net book value because the accumulated depreciation is deducted from cost. So the book value is $48,600,000. Now, when we get to the end of year 4, we realize, oh, this asset is going to last more than 20 years. In fact, it's going to last 25 years. Right? So we see here, if the asset at the end of year 4 is going to last a total of 25 years, and we used up 4 years already, that means there's 21 more years to go. Right? So the way we calculate the new depreciation expense is at the end of the year, in which we're going to change, right, the amount of depreciation. We take the book value of the asset, which is $48,600,000. We deduct the residual value. Okay, so originally we had estimated it would be $3 million. Now we're saying it's only going to be $2.4 million. So our net book value minus our new residual value, so that's going to be $46,200 multiplied by 1 over the remaining useful life, 21 years. So in that case, we get depreciation should be each year $2,200,000. So starting in year 5, we would change our annual depreciation from $2,850,000 to $2,200,000. We do this on what we call a prospective basis. Okay, prospective is PROSPECTIVE. Prospective. That just means going forward. Okay, so going forward in time, in this case, year 5, we record depreciation of $2,200,000. We do not go back and change prior year depreciation because for the 4 prior years, the depreciation was recorded using our best estimate, right? And so there's no need to go back and change the information because at the time, the information was correct, as was the $2,850,000 in depreciation as we originally calculated. It's just that at the end of year 4, we obtained some new information, meaning that the asset's now going to last 25 years, and also that the salvage value or residual value is 2.4 million, not 3 million. So we take that new information, recalculate depreciation expense, and then going forward, starting the following year, year 5 in this case, we record the new depreciation expense. So the journal entry in year 5 would be debit depreciation expense, $2,200,000, credit accumulated depreciation building, $2,200,000. So the accumulated depreciation at the end of year 5 would be the total at the end of year 4, 11,400,000 plus 2.2 million, right, for year 5. So the accumulated depreciation would be 13,600,000, right? 11.4 million plus 2.2, so it's 13,600,000. You should definitely know, okay, for the midterm exam, how to do these calculations with respect to changes in depreciation. It's a very common question on midterm exams. Okay, so we'll go forward to the next slide. Please excuse me while I'm speaking. I've caught a cold, and so I might sound rather nasal as you're listening to this recording. So I apologize for that in advance. I've sort of been fighting a cold actually for the last couple of days. So. Okay, it's not COVID either. You don't have to worry about that. I didn't get a test, but I'm feeling fine other than this little bit of a head cold right now. Okay, so the next topic that we want to talk about is what's referred to as the impairment rules under IFRS. Okay, specifically, as you see in the PowerPoint here, asset impairment. Now, by impairment, we simply mean by that word the asset is valued at a lower amount. Okay, something's happened to the asset which causes us to believe that the asset book value should be reduced. So the asset might have suffered damage in some way. Maybe there was a flood and a machine got damaged. Maybe there was a fire, right, and some machinery got damaged. It can be various causes, but management has to look at its assets and say, do we think we have incurred an impairment or not? Okay. So in the PowerPoint, it says impairment occurs when the cash generated by an asset is estimated to be less than the carrying value. So what they're talking about there is, if we paid $1 million for a piece of machinery, do we think by the end of the economic life of that asset that we will be able to recover our $1 million? Right? Will the asset last long enough for us to recover that $1 million from our business operations? If the answer is no, we have to look and see perhaps the asset is impaired and should be written down. Right? So we would reduce the recorded cost of the asset to another number. That other number would depend upon how much is the impairment. Okay, so they give us an example here in this PowerPoint. It says, assume that the book value of the rides at the theme park was $30 million. Okay, so remember, book value is cost minus accumulated depreciation. Okay, so that net number is $30 million. The next sentence says, if the fair value is estimated to be $5 million, then the impairment loss would be $25 million. Okay, value, okay, excuse me, fair value would be how much cash are we going to be able to generate if we sell the rides, right? And that's one number. Another number would be the fair value might be how much cash will we generate if we actually keep the rides and continue to use them, okay? So we have to look at both those numbers when we're looking for an impairment. So here they're saying the fair value of the asset. So either if we sell it, we can get $5 million, or if we use it, we can only write off $5 million before the asset breaks down and is not worth anything anymore. So we have to reduce the carrying value of that asset from $30 million down to $5 million because we have an impairment loss, right, of $25 million. So we would take our, we can look at it different ways with the basic accounting equation here, right? Assets equals liabilities plus equity. So if we reduce the book value of the asset, that means the rides and equipment on the balance sheet is going to be reduced by $25 million. That's why there's a negative sign there. Under shareholders' equity, the loss on impairment is part of our net income calculation for the period. And we know net income gets closed out to retained earnings. So this is the same as we've seen in some other examples. We know retained earnings is a credit, but this negative sign indicates that the loss is going to be a debit. Okay, so we have a loss which will be recorded in the income statement. That loss in the income statement then gets transferred to retained earnings. So we're saying here the retained earnings balance is actually going to be reduced by $25 million. The journal entry, right, to record the impairment, debit loss on due to impairment, $25 million, sorry, and then credit rides and equipment, $25 million. Now, normally, okay, good accounting would be when you credit rides and equipment, what I would suggest is the name of the account should not just be rides and equipment, it should be rides and equipment dash accumulated impairment. Okay, so just like we have accumulated depreciation on buildings and different types of equipment, we should also have an account called accumulated impairment. Okay, so in this case, rides and equipment dash accumulated impairment would be $25 million. Now, the reason I'm suggesting that you would have a separate account for that item is that the CFO and the CEO normally want to know what is the actual historical cost of their assets. So if we credited rides and equipment on the balance sheet directly, that would lower the cost by $25 million, right? So management would probably know that's an incorrect number in terms of what the cost of the asset was. Okay. In this particular case, the cost of the asset, I believe, was $60 million. So management wants to see what was the original cost, and then how much depreciation have we taken, and possibly how much impairment have we recorded, right, on that particular asset. Okay. Okay, so we'll go on from there. Okay, so the topic deals with disposals of tangible assets. Excuse me. Of course, when we talk about disposing of an asset, that could happen in various ways too, couldn't it? We might actually sell the asset. The asset could be destroyed by fire or flood, right? So the assets can be destroyed or made not useful anymore in a variety of ways. So the key to recording a disposal of a tangible asset is that you should always first update the depreciation expense to the date of disposition of the asset, okay? Because let's say a company has a December 31st year end, and it disposes of an asset on July 1st, 2020, okay? So we'll assume we're in the 2020 fiscal year. Well, that asset has been used, hasn't it, for 6 months. So we have to make sure our accounting records reflect 6 months of depreciation on that asset. If it doesn't, then our calculation of the gain or loss on disposal will be inaccurate. Okay. The next paragraph, it says, assume Cedar Fair sells one of its roller coasters for $50,000. The original cost of the asset was $100,000. It had accumulated depreciation of $60,000. Therefore, the book value, right, cost minus accumulated depreciation, the book value of the asset would be $40,000. Okay, and it says the gain on disposal, then they calculate what the gain would be. We credit equipment in order to eliminate the cost, right, of the original equipment. We have to debit our accumulated depreciation, $60,000, because if the asset is gone, we have to also remove the accumulated depreciation account. So we debited $400,000. Then we were going to debit cash, right, because we actually received cash of $50,000. And when we add up those debits, right, minus the credits, all on the asset side, right, plus 100, right, plus 60, so that's 160, plus 50 is 210, minus 80, right, is $270,000. Right? So we have a credit to equipment, debits of 110,000, credit of only 100,000. So we need an additional credit. So the way we accomplish that is we credit gain on disposal $10,000 in this case. Okay, gain on disposal. Again, the main thing I'll point out here, when you're doing a calculation for gains or losses on disposals, do make sure to record depreciation expense, right, for what we call the stub period. Okay, we have to record depreciation expense up to the date of disposition of the asset. Okay, you always have to do that. If you don't, the depreciation expense will be inaccurate in the company's financial statements. Okay, so we'll go forward from there. The next category that we're going to discuss with respect to capital assets, we've finished our discussion around tangible capital assets. The next few slides talk about intangible capital assets. So you might recall the other day when we were looking at these different types of assets, we said tangible assets are things you can touch. Intangible assets, they're assets of the business because they represent resources that are going to be used in the company's business. But that value, right, is intangible, means you cannot touch it, right, and recognize the value. So, for example, with respect to goodwill of a business, we know goodwill, we mentioned that's the excess earning power of a particular business. Well, generally speaking, companies do not record goodwill in their financial statements. Under IFRS, and generally accepted accounting principles, goodwill cannot be recorded unless it has been purchased. Okay, purchased goodwill can be recorded, but unless you've actually paid for the goodwill, it cannot be recorded in a company's financial statements. So that's a pretty important issue, right? Okay, so let's look at the intangible assets. We have, first of all, trademarks. It says it's a special name, image, or slogan identified with a product. So the most common trademark, mentioned the other day was probably Nike, right? Nike with the swoosh, right? When you see the swoosh, you know what company we're going to talk about, right? And so, or it would be like Apple, right? When you show the picture of an apple in its ads and they don't reveal the name of the company, the fact that you see that nice juicy red apple, right, tells you, oh yes, we're going to see a commercial about Apple. Right? So it just sort of follows the ads that are being put into newspaper or in digital format. The next category, copyrights. A copyright says it's a form of protection provided to the authors who do literary works, right? So that's people who write books. Musical, okay, it's people who write songs. Artistic skills, so people who do paintings or sculpture work, etc., those types of things. Drama, right? Drama, you may have an image of a certain person, that's important. And then there could be other unique types of assets that might exist where the value is derived from the author, right, of the work. Copyrights, of course, are well protected generally. Companies cannot directly steal a copyright from another company. They can purchase the copyright, but you're not supposed to steal it. Okay, the next heading, patents. A patent, as you see in the explanation, it says it's a right to exclude others from making, using, or importing an invention. So years ago, of course, when the telephone was invented, Alexander Graham Bell, who invented the telephone, he had a patent on the telephone. So if anybody else wanted to make a telephone, they had to pay him a commission or royalty, basically. So, of course, with many people on telephones, especially today, he would be making a lot of money, wouldn't he? Unfortunately, he passed away at a relatively young age and didn't get to see a lot of the fruit of his labor. So that was unfortunate. The last one I'll jump to, licensing rights. Sometimes you hear about licensing rights where typically a wealthy individual will grant a license to an organization to use their name. So the most common example of this would be President Trump with Trump Hotels. A lot of people I run into, they tend to think that, oh, Mr. Trump is very wealthy. He owns all these hotels. He does not own all the hotels. Some of the hotels he has a stake in, 1 or 2%, but he has many hotels that bear his name. The reason for that is he has licensed, right, the use of his name to those organizations for a specific period of time. Normally, in my past practice in dealing with people with respect to licensing rights, typically those licensing rights will be exercised in the early evening, typically. I mean, if you want to go on TV, you try and catch people right after the dinner hour before they go off and start doing things. Okay, so people or corporations that own assets can license the use of those assets to other organizations. Franchises, franchises, we know, is a common way of doing business these days. One of the main reasons for franchising is the owners have to raise their own capital. So that takes the burden off of the company that's actually building, right, the domain. And so in this particular case, a franchise will be granted, for example, a McDonald's franchise, right? So lots of burger places have franchise rights. So the issue here with respect to franchises is that the parent company, the company that gives you the franchise, typically maintains very strong control over what's going on in the particular franchise that we're talking about. And that's, of course, everybody doesn't appreciate that after they spend $2.3 million. People want to ensure, right, that they're going to benefit from spending that money sometime in the near future. Okay. So franchises can be very expensive, of course, to sell and to buy. A McDonald's franchise in Canada, assuming you're in a fairly large center, could cost over $2 million. And of course, there has to be built, etc., on top of that. So a very successful franchise is very expensive to get into. Other franchises that are less successful, of course, the cost is cheaper to get into a franchise which is not as successful as some of the larger franchises are. Goodwill. So we mentioned a while back that goodwill actually is the most common intangible type of asset that a company has in its financial statements, which is an intangible asset. Goodwill is essentially what we say it's the excess earnings value of a business. So Apple, for example, right, is making a profit of about $3 billion every quarter. So they're very profitable, right? And if you wanted to buy Apple, a lot of what you would be paying for is that future earning power. Right? So when you pay for that, that's referred to as the goodwill of the business. Under IFRS, goodwill can only be recorded if it is what we call purchased goodwill. Right? So somebody must have paid for it. We don't allow managements of companies to record goodwill unless they've actually purchased it from someone. Excuse me for a minute. I'm just going to take a drink of coffee. Okay. How do we record the acquisition of intangible assets? In this PowerPoint, which is number 20, it says the cost of intangible assets are recorded as assets only if purchased, right? So goodwill, we only record it if it's purchased. A trademark, we only record it if it's purchased. Some companies, of course, develop their trademarks internally, right? So Nike swoosh was internally developed. That has a high value, but we don't let that swoosh be recorded as an asset on the financial statements of Nike. Why not? Because no one has paid for it, right? We don't know what an objective value is for that particular asset. So costs which are incurred, okay, with respect to generating intangibles are written off as an expense, okay? Not recorded as an asset in the balance sheet. With respect to goodwill, they're talking about goodwill at the bottom of the PowerPoint here. It says the amount paid that exceeds the fair value of net assets is goodwill, right? So if you bought Apple, Apple would have assets on its balance sheet, so you determine the fair value of those. It has liabilities on its balance sheet, so you determine the fair value of those. You add those two numbers together. Right? And then you have to say, is there an impairment of the assets or not at the end of each calendar year? Okay, so at the end of each, usually calendar year, but if not that, fiscal year, okay, at the end of each fiscal year, under IFRS, management must have a look at the intangible assets and ask themselves, is there an impairment or not that has to be recorded? And a few minutes ago, we already talked about how to record an impairment, right? So we don't need to go back and revisit that. Okay. The use of intangible assets. These intangible assets that we mentioned a few minutes ago, typically they do have a legal life. So for example, a patent in Canada lasts for 17 years, okay? But the issue is the economic useful life of the asset might be substantially less than the legal life of the asset, okay? And that's what they're getting at in this particular PowerPoint with respect to intangible assets. So some intangible assets have a limited life, most of them do. Some intangible assets have an unlimited life. What's an example of an intangible asset that has an unlimited life? That would be goodwill. Goodwill has an unlimited life. We don't actually do anything to make it shorter, right? Goodwill can last forever. It can build up in a company, right? It's a tremendous asset. It can be bought, okay? But with respect to goodwill, we do not amortize goodwill, okay? Goodwill is reviewed for impairment, okay, at least once a year, at the year end when the financial statements are being prepared. Management must look at goodwill and determine is it impaired or not. Okay? So in this particular example here at the bottom of the PowerPoint, it says an intangible asset with unlimited life is not amortized, right? So that's goodwill, right? Goodwill has an unlimited economic life, and so we don't have to claim depreciation. It's not going to wear out, right, over time. That's sort of the logic, basically, with respect to that one. Okay. However, things like patents, copyrights, franchises, they normally all have a period of time during which the copyright, the license, the franchise is valid, right? But at the end of that period of time, the franchisee may have an option to buy the business, maybe not. May have an option to sell the business, maybe not. Okay, so there's various ways that intangibles with unlimited lives can be dealt with. But the main thing to remember is they are not amortized. They must be considered for impairment at the fiscal year end of the business. Just above that in the PowerPoint, it talks about limited life intangibles. So these are things like this here, copyrights, patents, licensing rights, and franchises, they do have a limited life. So as a result, those types of assets, we use the term are amortized. Okay? So with respect to depreciation of tangible assets, we use the word depreciation expense and accumulated depreciation. For intangibles, we use the word amortization. Okay, amortization is just another word for depreciation, right, in the English language. So intangible assets are different than tangible. So as a result, we wanted to call the depreciation of an intangible asset something other than depreciation. But the methodology is basically the same. Okay, very often for intangible assets, management will use the straight line method of amortization. Why? Because the theory is that every period benefits in the same amount from the existing of the particular asset. Okay? So maybe in the fifth year, if an asset only has 5 years left, be in the fifth year, there should be some adjustment to recognize the fact that the asset's going to be written off at the end of the fifth year. Okay, so again, limited life assets are not amortized, but you review those assets once per year for impairment. All the other assets, which are intangible, they are all amortized over their economic useful life, and then you also have to consider impairment on those assets, even after you amortize them. So impairment has actually generated, unfortunately, a lot of extra work for management, because you have to look at this at the end of each fiscal year and say, do we actually have an impairment on our assets or not? Okay, so that finishes the discussion of capital assets, both the tangible assets and the intangible. You see the intangible asset discussion is a lot shorter, a lot easier, right, compared to the tangible asset amortization. Now, there are a number of important ratios when we look at financial statements. And of course, one of the reasons we want to ensure that our accounting is correct is because if our accounting is incorrect, it means the ratios that we calculate will also be incorrect. Now, with respect to capital or fixed assets, one of the most common ratios is called the fixed asset turnover ratio. So how do you calculate that? It says take the net sales revenue. What is net sales revenue? That's the gross sales revenue minus cash discounts, minus sales returns, and sales allowances. Okay? Those three numbers all reduce sales to get the net sales number. Then you divide that by average net fixed assets. Average means you take the fixed assets at the beginning of the year and at the end of the year, and you calculate an average, right? You just divide by 2. So that's how you calculate the average. The net, the word net simply means that you don't take the cost of the assets, you take the cost of the assets after deducting accumulated depreciation and accumulated impairment if it exists. So that way, once you do that, you have the net fixed assets, right, for the business. So to calculate the fixed asset turnover ratio, we're simply going to take the net sales revenue and divide it by the average net fixed assets. So you can see when we look at this ratio, the higher the fixed assets are, right, in terms of dollar amount, the lower this ratio is going to be. Because that makes sense, because if this ratio is actually decreasing, it means you're being less efficient, right? You're increasing your business's fixed assets to a higher and higher number, but you're not generating the amount of profit and cash flow that you should from your business. So that's going to show you might have a low net sales revenue and a high net fixed asset balance because you're continuing, as I said, to buy machinery and other long-term assets. So once you do this ratio, it's very often, especially today, going to show the company that they should be generating more revenue given the size of investment that's in their fixed assets. Okay, so if we look at the right-hand column, it says what it tells you. It says indicates dollars of sales generated for each dollar invested in fixed assets. Fine, well, you do have a ratio. Okay, so that's true. And then it says a higher ratio implies greater efficiency. Right. So if we have an average investment in net assets, let's say of $1 million, right? If our net sales revenue is $2 million, that's a 2-to-1 ratio. If our net sales revenue is $10 million, right, and we're doing that with a $1 million net, that's a 10 times ratio. So of course, what you want to try and do is maximize your sales revenue, but to the extent you can, minimize your net fixed assets. When this ratio is a low number, it's going to tell you that you have too much money invested in your capital assets. How do you get rid of those assets? You're going to have to dispose of them somehow, right? So possibly sell them, right, would be the most common way to get rid of those assets. And typically you would sell them to a competitor, right? Because who else is going to use the machinery, right? So you get into those types of discussions with your competitors. Okay, impact of depreciation rates. So this particular PowerPoint talks basically about a summary of what we've already talked about in this chapter. So the first bullet point, it says depreciation varies from company to company. Well, of course it would. Right? Can you guess why? Well, we talked about assets having economic useful lives. We talked about assets having residual values. The odds are pretty high that the management members of each company are going to assign, right, different useful lives and different fair values upon disposition to the assets. You're not going to have the numbers exactly the same. So that means the depreciation reported by a group of companies in a common sector is going to be quite different. Okay? Depreciation, we already saw the other day, can be calculated in various ways, right? Straight line method, right? The double declining method, the sum of the year's digits method. So those three methods we talked about. Again, we know depreciation is it really depends on two items. The useful life of the asset, which we've already talked about, usually referred to as the economic useful life, and then the residual value. Right? So again, when management sits down and says, what is the residual value? What is the economic useful life? Management teams may well have a different answer than another company's management. So again, what can happen is the profit of different companies can look very different depending upon the depreciation methods, right, that are being used by the organizations. Okay, we've already looked at this previously. This PowerPoint is just comparing the effect of the straight line method, right, of depreciation to the double declining balance method, and we can look at the depreciation expense, right, under the declining balance method is much higher per year than it is under the straight line method. Right? And it does get to the point where it changes, but generally speaking, right, the double declining balance depreciation is going to be higher in the first few years, right, than the straight line method. Then you see where this color line is here, the yellow line. This is the first year where the depreciation under the double declining balance method is less than under the straight line method, right? And so we saw this the other day. The double declining balance method is very aggressive. It writes off assets fairly quickly, where obviously the straight line method of accounting does not do that. Okay, so in this particular text chapter, there is a supplement. So I want to spend a few minutes on the supplement because it talks about one remaining issue. And there's something that's a little unique about this issue. That's why I want to take a few minutes. just to cover it off with you. And you can see it says comment, and so this is something extra, right, that they're talking about right at the end of the chapter. And what they're talking about is natural resources. So by natural resources, as they state here, oil and gas companies, mining companies, and timber companies, right? So companies that are going in and cutting down trees and forests, basically, to make paper or other types of products. Okay? The accounting for this particular type of industry is quite complex. And if we thought it for a minute, why would it be complex? Well, the way that they do their depreciation for natural resource companies, they have to estimate what the output is going to be. Okay, so remember we talked about the other day the three depreciation methods. Right? And one of those methods said you have to know what the output is going to be of the particular asset. Okay, so in this case, natural resources for oil and gas companies, we have to estimate how many barrels of oil, for example, are we going to be able to take out of the ground for the site that where we're at. For mining, how many tons of, let's say, coal are we going to be able to bring out of this mine? Right? In timber, the question is how many board feet of lumber will we be able to produce from the trees that we're going to cut down in a forest? Right? So these numbers are all based on output. Right? What's the output going to be? We have to somehow estimate that, and that's why for oil and gas companies, they hire geologists, right? People who are trained to look for things underground and try to find significant deposit of different minerals. Okay? Same thing for mining companies. They do the same thing, right? They'll survey certain areas to say, well, is there a silver deposit there, a gold deposit, or right, other types of metals that they might be looking for. Okay, excuse me again for a minute. Okay, so we'll go forward, and there's a little example I want to review with you. So you can see the heading in this PowerPoint is called depletion. And what we've talked about previously for tangible capital assets, we said they are depreciated, right? For intangible capital assets, we said they are amortized. Amortization and depreciation are very similar processes. Those processes are simply there to allocate the cost of an asset to the income statement as we're using up the asset. Remember we said depreciation and amortization is the same. They are cost allocation methods. We're just taking some of the cost of an asset and allocating it from the balance sheet to the income statement, right, on some type of systematic basis. Now, in this particular example we have here, they're talking about a forest. So it says when we cut down trees in a forest, right, we don't have the trees there anymore, do we? So what are we doing? We are depleting the forest, right, as we cut down the trees. So in the extractive industries, mining, timber companies, oil and gas companies, etc., we use the word depletion. Okay, so in the PowerPoint, right at the top, it says depletion is the process of allocating a natural resource's cost over the period of its extraction or harvesting. Okay, so we have to measure the natural resources cost. That's going to be pretty easy most of the time because you're actually going to pay, right? Pay for a forest, right, that you want to go in and cut down. So what's the cost? And then we have to identify, it says we deplete the asset, whatever the cost is, by extracting the asset, right, or harvesting the asset. So we can think of the most common example here will be a coal company. Right? We're going to take coal out of the ground. Now here, they're going to use a timber company. So it says a timber tract. A tract just means a piece of land. So a timber tract costing $530,000, it says is depleted based on a cutting rate of 20%. So what that means is each year they're going to cut 20% of the trees that are in the forest. So each year, this cost of $530,000 is depleted by $106,000 each year. 530,000 cost multiplied by 1 divided by 20. Right? So it's 530,000 divided by 20 is going to give you $106,000. So the depletion each year is $106,000. So when we would depreciate an asset, our journal entry was what? Debit depreciation expense, credit accumulated depreciation. But when we deplete an asset, our journal entry is different. We credit accumulated depletion, right? Because we're going to keep adding in that account how much we're getting out of the forest each year. But the debit does not go to depletion expense. The debit goes to timber inventory, right? When the trees are cut down, we have more trees to ship out, don't we? So we actually have timber inventory. So that's an asset, right, that will be recorded in the financial statements of the business. So our journal entry is going to be debit timber inventory, credit accumulated depletion. Right? Again, the 160 being the depletion on the asset. So again, debit timber inventory, not depletion expense. Right? Most of the other assets we would be debiting depletion expense, but here we don't, because when we deplete the asset, we still have the wood, don't we? We still have the wood to cut. We cut the tree down from the forest, so the forest doesn't exist anymore. But now we have wood in inventory, right? So we essentially store up the depletion of the asset until the asset is sold. And of course, this timber inventory, right, that's going to be 530,000 plus the 100,000, right? So we're going to have timber inventory, okay, available for sale. So this journal entry, we debited timber inventory 106,000, credit accumulated depreciation. Let's say next year we sell half the inventory. So when we do that, we're going to credit timber inventory, debit cost of goods sold, timber inventory for how much? 53,000, right? If we sold half of the inventory, we're removing half of the inventory and we're going to debit cost of goods sold. So here's the journal entry in terms of what we just talked about for the 106,000, debit the inventory, 106,000, credit accumulated depletion, right? So all the costs do end up rolling into the inventory account. So at least that part is good from a consistency perspective with other financial statements, okay? So our timber inventory, as it says at the bottom of the PowerPoint, it stays on the balance sheet until the actual timber is sold, okay? And that ends what's in chapter 9. So with respect to today, right, the depletion process, right, important to understand that. Important to understand how depletion is recorded in inventory in the extractive industries, oil and gas, forestry, right? And then also, we talked about changes in what we call depreciation estimates. Right? How do we do a new calculation when we change the useful life of an asset, right? Or when we change the residual value of an asset, or sometimes we change both, as they did in the example in the text. Okay? So this will be, I'm going to end the lecture today rather than starting in the chapter 10. So realize I've used up just about half our time today, which is okay. Other weeks, other days, I know I've gone over or a lot of time each day. But what I'd like you to do is, in the extra time that you have today, please work on the assigned exercises, okay? Because again, the midterm exam questions are going to be very similar to the exercises that you do, and also with respect to some of the problems that we've covered in the PowerPoint material. Okay, so those are the key two things that you should continue to focus on in terms of getting ready for the midterm exam. As well, if you prefer, of course, you can start working or keep working on the accounting assignment that I've distributed, right? So everybody needs to start getting going on that. Once we do next week's lecture, it'll be easier for you to deal with some of the information that's in that exercise. Okay, so I gave it to you very early, just so you can start looking at it and trying to figure out the journal entries. In case you need some extra time to do that, you've got lots of time. But as I said, really, by the time we get through next week's lecture, you'll have an even better understanding in terms of how to record some of the journal entries that are requested in that particular assignment. Okay. Okay, everybody. Thanks for coming today. Appreciate your time. And please, I'll see you next Tuesday in class. If you do have any questions on the accounting assignment or, again, any of the exercises, once you look at the solutions, please contact me. Okay. Take care. Have a good day, and we'll see you next Tuesday.